As mentioned, I'm Peter. I run the insights team at Carta. Carta is 45,000 cap tables strong these days. So if you are planning to fundraise from VCs and you want to look good right before your meeting, please jump on Carta. I'm not going to pitch you on Carta at all, though. What I'm going to do today is give you a ton of data about how much ownership we see SaaS founders having at various stages through the VC journey, in addition to some real fresh market data on what valuations, round sizes, et cetera, are for SaaS companies. This is from our lawyers. They require me to put it up. It's not a great way to start a speech. Before you ask, I would love for you to take out your phones and screenshot every single slide of this. That would make me feel great, but you don't need to. You can just email me, peter.walker@carta.com, and I will send you the slides. Oh, okay. All right, we'll do that. So today we're going to be talking about SaaS ownership and VC funding, but the core thesis of this is just dilution. And all that is you as a founder giving up a percentage of ownership in your own company, hoping that the valuation of that company explodes with the capital that you've raised, and it ends up being a good trade. So if we skip ahead a decade, you are now the founder of a company that is about to IPO on the NASDAQ. How much of your company are you going to own on that day? If you're the founding team at Atlassian, you owned 76% of your own company on the day of IPO. If you're the founding team at DocuSign, you owned 2% of your company. This is not to say that the founding team at DocuSign messed anything up. Maybe they made the choices they needed to, and they IPO'd on the NASDAQ. That's an incredible outcome. But you want to track dilution over time because it can really, really sneak up on you. And there are 4 main sources of dilution: your friends and co-founders, your employees, your early investors, and your later investors. So we're going to go through each one. First off, your co-founders. How many of you are founding this company on your own? How many of you are solo founders? All right. You all are becoming more and more common every day. The highest percentage of solo founders we've ever seen was last year on Carta. However, VCs don't like you. I'm sorry to say it, the data is super clear. If you are a VC, if you're trying to fundraise from VCs and you are a solo founder, you're less likely to do so. We can talk about whether or not that's fair or not. Hint, it's not, but it's reality. So will you need a co-founder? It's one of the biggest questions that you're going to come up to at this early stage. Second question, you have a co-founder, you're sitting there before doing any fundraising, any hiring, and you're talking about splitting this company between you. Should you just split the company 50-50 if there's 2 of you? Well, more and more founders are choosing that pathway. About 46% of 2-founder teams on Carta split 50-50, which obviously implies that the majority still do not, right? Unequal splits are still far more common in VC than equal splits, especially if you have 3 or 4, or God forbid, 5, 6, 7 founders. By the way, if you're a SaaS company with 7 founders, have a long discussion amongst the huge group of you and decide who needs to be a founding engineer instead. 7 is too many. So how do these companies get split up? At the beginning, 51-49 is the median split we see on Carta. And then on down the list. And you can see very clearly that as you have more founders, there's typically one with an outsized portion of ownership, and it's probably no surprise to you that that is the CEO, almost always. All right, there are probably a lot of ways to kill your startup, probably more than we could list, but one of the easiest ones that we found is for you to own your shares outright without a vesting schedule. And that seems silly, right? It's my company. I started it. I conceived it. I built it. I should own my equity from day one. But if you do that mental exercise, if both of you own 50% on day one, and one of you ends up leaving after a year, congrats. That's 50% of your equity gone forever. And then good luck raising from VCs. You won't do it. So vesting schedules are actually protective to you, the co-founding team. So you should have a vesting schedule on your own shares. By the way, co-founder breakups, I know it will never happen to anyone here. You're in happy marriages, all of you. But 25% of companies on Carta will lose a co-founder before year 4. And a lot of them won't even get to year 4 because the co-founder breakup killed the company. It's a very common way for startups to fail. All right, we sped through that. That was co-founders. Let's talk a little bit about employees. You'll probably be hiring some employees, although maybe some of you will just choose to hire agents instead. And you will give those human employees equity most of the time. VCs might say your option pool, the pool of equity from which you'll give employees their ownership, needs to start at something like 15 or 20%. Too high. Start it at 10, even 8% at the very beginning. And then as you fundraise, you will negotiate with your VCs to expand the pool. You do not need to over-dilute yourself up front and give them basically equity for free. But then that brings up the question, how many people do you need to run this company? If you raised a Series A round in 2022, you probably had something like 20 employees that worked for you. Those that raised a seed round in 24 had 15 employees. And if you looked at this number in 2025, it's already 13 employees. Smaller teams, moving faster, the data is very clear. That's happening across the stack. Now, some of you might say that's AI. I actually think for the last couple of years, it's mostly just been founders being more capital efficient and treating money with a little bit more reserve. But AI is certainly going to play a role in that number moving forward. And I don't expect any of those bars to bounce back up significantly. So how many people are you going to hire is a huge, huge part of how you're going to spend this money. All right, pre-seed. So you've built a founding team. Maybe you're getting started on a product. Maybe you have a few initial design partners, customers, et cetera. You're trying to raise a pre-seed round from angels or small VCs. The first question you should ask yourself, do I really need outside capital? In this world, it has become far easier to get a prototype, to actually have customers, to get money in the door before engaging with the VC ecosystem. Because when you do this, you are committing to something important, and that is someone else's growth path, right? VCs are not, if you get a loan from a bank and you pay that bank back, congrats, you never have to talk to that banker again. If you get a VC investment, you are speaking to this person at least once a quarter until your company goes kaput. It's a long-term relationship. VC is very expensive capital. And so companies are choosing all sorts of ways to fund their businesses. Many are trying bootstrapping, just the money they have and the revenue they're going to bring in. Some are going the full VC path. Some are choosing this fancy seed strapping, which is I'm going to raise one round of VC only and then get as far as I can with that. Side note on that, many people are talking about it. And I hear from VCs that many of those founders are secretly talking to Series A VCs as well. So maybe it's happening a lot more than it used to, but it's being spoken about a lot more than it's happening, in my view. Or late VC. You talk to VCs, hey, in 3, 4, 5 years when you have a real business. All perfectly wonderful ways to fund your company. But if you go for angels in small institutionals, you'll almost certainly do that on a safe, simple agreement for future equity. If you don't know what that is, look it up right now, because it's almost certainly going to be the document that you sign to get that initial capital in the door. And so there are two terms that matter on a safe, a valuation cap and a discount, but the one that you're probably going to negotiate is the valuation cap. Rule of thumb, if you're raising $1 million today in the US from angels or small VCs, that is most commonly done on a 10 million post-money valuation cap. $1 million raised, 10 million post means you sold 10% of your business. And I'd encourage you to think about it as dilution, even though, of course, you get that money today and then, hey, those investors will get equity at some point whenever I raise a price round. Don't think about it that way in your head. Use the YC model here, which is I give you $500,000 for 7% of your business. That's how you should be thinking about safes. Safes are not free. I cannot tell you how many founders that we have spoken to over the last 2 years who say, I raised 2, 3, 4 rounds on safes, I didn't understand the dilution, and now I own a lot less of my business than I thought. It's very common. So, safes are great, don't stay on them too long. You're going to fundraise on safes for small rounds, like less than $1 million, definitely, 1 to 2, maybe. And then you're going to talk to real lawyers and get a priced equity round, standard venture stuff, when you're raising $3 to $4 million. And again, do not raise too many rounds on safes. They are a siren song. But 1 round is great, 2 is okay, 3 or more probably should go to priced. And then you're talking to the VCs, the ones we all know, Series A, seed, Series A, Series B, etc. If you thought we were going to get through this without mentioning AI, we have to, because it is every VC's favorite thesis at the moment. All the crypto VCs are now AI VCs. Many of the hardware VCs are now AI VCs. Many of the angels are now AI angels. It's fun. It's exciting. But the data proves that they are valuing these AI companies quite significantly differently than non-AI companies. So this is just within SaaS. There's a 41% premium on AI SaaS valuations versus non-AI SaaS valuations. That is repeated in Series A. That is repeated in Series B. It is true all across the stack. And it brings up an interesting question. What is an AI company? Does it count? Do I get those higher valuations if I'm just calling ChatGPT? Do I have to have data that I'm fine-tuning a model with? Do I have to be building my own model? What counts? We have spoken to literally hundreds of VCs, and I've gotten hundreds of answers to that question. So no one can tell you exactly what constitutes AI or how defensible your version of AI will be. It's up to you to convince the VCs that you deserve to be on that orange line rather than the black one. And of course, we can talk for a long time about whether always taking the highest valuation is good for your business. It isn't, but that is a personal choice. So I don't want to talk to you one way or the other about the deals that you're involved in. Series B also up, and you can see that for a while there, venture valuations dipped in 23. They've popped back in 24, and they've continued to increase in 25. Higher valuations, but fewer companies getting funded. More competition at the high end, but there is a whole swath of companies that are having a really difficult time fundraising right now. So I wouldn't say that VC is fully healthy. It's a little bit top heavy at the moment. Series B, same kind of idea. And then we get to the fun part. How much are you going to sell? The standard venture terms of you're going to sell 20% in your seed round and 20% in your Series A, those are holding very true. And then Series B, Series C, as you get to be a very big, mature company, you're going to sell less of your equity in each round because it's worth a lot more. Makes sense. This is maybe the most important slide in this whole deck. The time between rounds is skyrocketing. That orange zone in the middle, that's the standard VC advice, which is you're going to fundraise every 18 to 24 months. That is out of date at every single stage. The median time between rounds is more like 2.5 years. Or 3 years. So if you're sitting there and thinking, if I don't fundraise in 18 months, my company is going to go under, you need to find ways to make that cash last longer than you think, because it might need to. Now, some of this is because founders are trying to raise and can't. And some of this is because founders are raising and then saying, I don't need any more capital. I choose not to raise again. Both of those things are happening, but it is contributing to these really, really high lines. And so then we bring it back to you, the co-founders. What happens to your equity? What happens to your ownership as you've gone through all of these stages? Okay, the big black circle is the median amount that the founding team owns after the round is completed. SaaS companies only. Companies have raised from in the last 5 years or so. I'm sure some of you are whispering and saying, damn, that feels like a lot less equity than I had expected, right? After a Series A, the median amount owned by the founding team is 38%. So where does the rest of it go, if not to founders? So you've got that orange bar is you, the founding team. Salmon is employees. Gray is investors in the round. And light gray is everybody else who's already on the cap table. This is a lot of dilution really quickly. I hope this points out the fact that venture is very expensive in terms of equity. Taking money from VCs means you'll have to deal with a lot of them, and they'll have a really big say in how you run your business. So when will you lose control of your company? VCs don't like it when I say lose control. When will you share control with wonderful investors in your company? Probably Series B or so. You will no longer, you and your employees will no longer have 51% of the company. So again, this just points out you need to have the right investors on your cap table. You don't want to get fired by your VCs. Doesn't happen often, sucks when it does. And the last point here is around your ownership as the CEO. Obviously, it's very sensitive to how many founders there are to begin with. The black line is 1 founder, then 2, 3, and 4 founder teams. But as you can see, it converges very quickly into about the same level at Series D, Series E. So getting back to that first slide we saw, when you IPO at the NASDAQ, you as the CEO might own 8 to 10% of your company. And that's an unbelievable outcome because hopefully you're IPOing for billions and billions of dollars. I know I sped through that, but I wanted to make sure that I saved a couple minutes here for questions. So if you have a question, AJ can walk around and give you the mic here. Any questions on dilution, founder ownership, anything that we touched on? What's going on in VC overall?
Hey, awesome data. Thank you for that. Can you elaborate more on safes versus convertibles, what you see, what works, and what doesn't?
Totally. Great question. So safes have come to dominate within SaaS because truly the only difference between a safe and a note is that the note has an interest rate, so it's technically debt. And who likes an interest rate? Who likes debt? It's easier to do a safe, right? The problem with safes, or maybe not the problem, but the way they are set up, by definition, because YC took the pre-money safe off of its website, most people use post-money safes. The post-money safe is a wonderful instrument because it gives you clarity. It allows you to say, I am selling this percentage of my business in a much more easy way. The downside of that is it gives these investors anti-dilution for free. So what that means is if you raise a round on safes and then go to priced and then raise another priced round, all those earlier investors start to suffer dilution alongside you. If you raise 3 rounds on safes, congrats. When you raise that 4th round, you, the founding team, are the only people who will get diluted by that new investor. So you're giving them a term that if you negotiated it with a lawyer, you would probably never give them. And you're doing that because it's faster and it's cheaper. And safes are a hell of a lot cheaper. There's no doubt about that. So I love safes to get started, but I think founders are sticking around on them too long. Yeah. The question was, is there any interesting trends around private equity entering SaaS and SaaS funding? I think private equity, we've certainly seen an increase in small M&A over the last 2 years. A lot of that is private equity doing roll-ups. And by small, I mean companies that are between seed and Series B-ish. So that is an entry point. I don't hear a lot about private equity investors taking minority positions like VCs these days. So I probably wouldn't spend too much time pitching PE unless you're trying to get rolled up.
And Peter, one final rapid fire question.
Nice.
Hi, Peter. Bianca from ChartMogul. I just have a question because you're working with such a fantastic data set. I love what you're sharing on LinkedIn. Is there anything in the data that just really surprised you or really is just like, gives you a headache?
I get a lot of headaches from our data, but what's the most surprising thing? I think one of the sadder things, to end on a bummer note like I like to usually do, is employees right now are exercising a lower percentage of their shares than we have ever seen on Carta. So when an employee leaves, they come up on that exercise decision. You have 90 days typically. Right now, we're seeing 70 to 75% of employees say, no thanks. I'm not going to exercise these shares. I'm going to let them go back to the company. Hopefully, that's a lagging indicator, and the market's going to get better, and then employee optimism rises. But, as is usual, that's a Debbie Downer note for the rest of you. Anyways, if you're a founder, jump on launch. It's free till you raise $1 million. If you're on Carta and you're raising a price round, scan that deal closings QR code. We'd like to save you a lot of money on your next price round. Appreciate the time, y'all. Thanks so much.